As with all chapters, you should read the chapter first and then complete the preview questions found in the course note packet. Then you should play the lecture of the narrated PowerPoint slides so that you already have an idea of what the chapter covers, and then the lecture should emphasize the most important and perhaps most difficult points in the chapter. So read the chapter, do the preview questions, then watch the lecture. Chapter 3 has 3 learning outcome statements. The first one is to use financial ratios to determine the health of a company. The second one is to apply DuPont analysis that helps us look at return on equity, which is a very important number from the financial statements, and to take that return on equity and try to examine 3 different components of return on equity so we can have an idea how a firm might actually produce a higher return on equity if it were to refine its operations or change its capital structure, including maybe the use of more debt or something like that. And the third learning outcome statement is to explain the limitations of ratio analysis. Ratios are very helpful, very useful, but we need to understand there are significant limitations in how they can be used or perhaps how they should or are actually used. Again, read the chapter, complete the preview questions, and then do the lecture. In Chapter 3, we want to use financial ratios to evaluate the financial health of companies, apply DuPont analysis, and explain the limitations of ratio analysis. The purpose of ratios is to take the accounting numbers from a firm's financial statements and put them in a relative sense. Thus, complicated financial statements can be much easier to understand and interpret. By a relative sense, we mean we're going to take a firm's financial information and compare it to some benchmark, such as the firm itself across time, looking at different trends in the ratios, such as, is the firm's liquidity position improving or is it declining over time? Is the firm taking on more debt compared to its assets over time? In other words, is it being financed differently now than it was a few years ago? And the second benchmark is to compare the firm to peer firms in its industry or often an industry average. The definition of an industry is not all that precise sometimes, so we use the standard industry classification codes. For example, Table 310 in the textbook shows different SIC codes such as agriculture, forestry, and fishing as a broad category, and underneath that, agriculture, production, or forestry, or fishing is broken down. Those are the 2-digit SIC codes, and they do go out to more digits to more precisely define an industry. Let's think about who might be some of the users of financial ratios. And you put this on a personal level sometimes, it might make more sense. Creditors, if a corporation wants to borrow from a bank, they need to take good financial statements to the bank. If they want to get other new investors to invest in their stock or bonds, they probably have to have audited financial statements to be registered so they can issue securities to the public, so the investors would have access to those financial statements. And shareholders want to see the management's discussion about how well they're performing. So the managers want to use ratios to make themselves look good, and the shareholders want the ratios to really understand how management is doing. Regulators might want to know how a company is performing. So if a firm wants to put forward a rate increase, such as a public utility might do, and in Missouri that would go to the Public Service Commission, then the utility needs to show that the rate increase would be necessary for their shareholders to get a fair return or something like that. It could also be used in a case where there might be monopoly power, such as an antitrust suit or something like that, to show one firm is dominating the market and is restraining trade or something like that. So there's a lot of cases where we would see financial ratios used. But on the personal level, if we go to a bank to borrow personally, such as for a home mortgage or a line of credit or even an auto loan or what have you, they're going to want to see our personal financial statement to decide if they would loan us money or not. In Chapter 3, the authors divide the ratios up into 5 categories. The first one are ratios used to measure liquidity. In liquidity, in this sense, how liquid the firm is, we're talking about its ability to meet financial obligations that are coming due within the year. Liquidity is typically, is a fairly short-term phenomena, so typically when we talk about liquidity, we're looking at a one-year horizon. The ratios used to measure liquidity are the current and the quick ratios. The current ratio is basically net working capital that's been stacked up. Instead of current assets minus current liabilities measuring net working capital, the current ratio is the ratio of current assets to current liabilities. The quick ratio is trying to measure the same thing. Both ratios are trying to measure liquidity. But the quick ratio is very similar to the current ratio, but it has excluded inventory from the numerator. In other words, the quick ratio is all the current assets minus inventory, or you could think about that being that we added up all current assets except for inventory and divided by current liabilities. To illustrate the various financial ratios in the chapter, we will use the mini case found on the last 2 pages of the chapter, which uses financial information on S&S Air Incorporated. It gives some background information about S&S Air's function in the small aircraft manufacturing industry, and then it provides the income statement on S&S Air, and then on the next page, which is the very last page in Chapter 3, it provides a balance sheet for S&S Air, and then it provides some industry ratios for the light airplane industry. Each of those ratios is provided with a median number, a lower quartile, the number of which 25% of the firms are below on that ratio, and the upper quartile, the number of which 25% of the firms are above on each of those particular ratios. We'll focus on the median for the ratios that are given and make comparisons between S&S Air and the light airplane industry ratios, again using the median number for those ratios for comparison. To calculate the current ratio, we take the current assets and divide by the current liabilities. Both of those will come from S&S Air's balance sheet. The current assets are already subtotaled for us, $1,967,860 for total current assets, and the total current liabilities are subtotaled as well, $2,773,050. So we take that total current assets given on the balance sheet and divide by the total current liabilities given on the balance sheet. And S&S Air has a current ratio of 0.71 or 71%, meaning for each dollar in current liabilities, the firm has 71 cents of current assets. The industry median is a little more than twice that at 1.43. So obviously that is not a very good sign about S&S Air's liquidity. It has about half the current ratio that the industry has when looking at that median number. So I would say that S&S Air's liquidity position as measured by the current ratio is certainly poor. The quick ratio is another measure of liquidity. It looks at all the current assets other than inventory, because inventory tends to be the least liquid of the current assets. So we'll take that same subtotal for current assets, $1,967,860, and I'll back out or subtract off the inventory, $933,400, which was given on S&S's balance sheet. Inventory, $933,400. $33,400. I subtract off that inventory and divide that numerator by the same current liability total we used before, and I see S&S has a quick ratio of 0.37, which does compare just a little bit better than the average, the industry median. So I would rate their liquidity as average, just slightly above the industry median as measured by the quick ratio. So we see both of these ratios are trying to measure the same thing, liquidity. Can S&S meet its current obligations? Well, by looking at the current ratio, we would say no, it does not have very good liquidity. But when measured by the quick ratio, we see its liquidity is average and actually just slightly above the industry median, again using the quick ratio. So the question becomes, what is the nature of S&S's inventory? It's really causing that current ratio to not look very good. Maybe a lot of its industry competitors have a lot of inventory, and that's making their current ratios look higher. But if that inventory is not really liquid, maybe the current ratio is not a very good measure of liquidity. We don't know. We need to know more about that inventory. If we ignore the inventory, S&S compares actually slightly favorably against its industry competitors. So if inventory is not terribly liquid, and we would be justified in excluding it, taking it off, and measuring liquidity by the quick ratio, then S&S is in okay shape liquidity-wise as measured by the quick ratio. So the quick ratio is a better measure of liquidity than the current ratio when we don't think the inventory is usable, when it's not liquid, when it is perhaps obsolete and maybe overstated on the balance sheet compared to what its actual market value is. So if we don't think the inventory is usable to meet current liabilities, the quick ratio would be a better measure of liquidity. When we compare a firm to its benchmark, such as the industry average or median industry ratio, we need to have some idea whether the comparison is good or bad, such as S&S was poor comparing the current ratio, and it was average comparing the quick ratio. So would a current or quick ratio necessarily be better if it were higher? And should those ratios be as high as possible? Well, as high as possible is probably enough information to tell us the answer to this is no. Things need to make sense. Things need to be reasonable. So think about current assets. We need enough current assets to do business. We need enough cash on hand. We extend customers credit, so we'll have some accounts receivable, but that's our cash in their hands. We need enough inventory to meet customer demand, but not so much more inventory or so much more accounts receivable or cash than is really necessary, because current assets just don't earn anything. It's not efficient to tie up excess resources in current asset form, because they're costly to maintain. Cash doesn't earn anything, accounts receivable doesn't earn anything, inventory doesn't earn anything. In fact, inventory has to be stored, it has to be insured, it's subject to obsolescence or shrinkage where it walks out the back door. So we need enough current assets to do business, but not more current assets than necessary, and certainly we don't want to pile on current assets when they're not needed just to boost our liquidity ratios, because too much liquidity can be a bad thing. It can be costly to maintain too much liquidity. The second category are the long-term solvency measures. In this case, we're trying to look at how the firm's assets are financed. Solvency being able to meet obligations, insolvent being bankrupt or not able to meet obligations, gives you some idea that we're talking about how much debt the firm uses here. So debt is obviously financing by creditors, and equity is financing from stockholders. So if we look at the relative percentage of the firm's assets that are financed by debt, we'll call that the debt ratio or the total debt ratio. I like to think about the debt ratio as having a more long-term focus because we're talking about collateral value. We're talking about how much of the firm's assets are financed by creditors. And that implies that one might have to foreclose or seize the assets of the firm, sell them off to satisfy the debts if the firm gets into financial difficulty. Another solvency measure is the times interest earned ratio. That is a shorter term focus because we're measuring this kind of as an ongoing measure of the firm's ability to make its interest payments out of the operating income that it produces. So that's kind of a year-to-year income type measure, whereas the debt ratio is a longer-term liquidation type of measure. The cash coverage ratio reminds us that depreciation expense is a non-cash deduction. And the income statement will show the depreciation expense having been deducted, but since that's not an actual cash outflow, that does not hinder the firm's ability to pay interest. So when we define the cash coverage ratio, we'll be adding back the non-cash depreciation expense deduction. So the debt ratio is just like it sounds, debt as a percentage of total assets. Times interest earned is how many times we cover our interest expense using operating income. Earnings implies net income a lot of times, but in this case we want to use operating income because that is earnings before interest and taxes, earnings before the interest and taxes have been subtracted. So by using operating income, we have not yet taken out the interest expense, so we will be covering it here out of operating income, not covering it out of net income or something that would have already had interest expense subtracted once. So operating income will give us a better picture how many times we're able to cover our interest expense, certainly out of operating income. Then the cash coverage ratio takes that same operating income in the numerator of times interest earned and adds back the non-cash deduction for depreciation expense. So again, it puts it more on a cash flow basis by adding the depreciation expense back onto the earnings before interest and taxes in order to cover interest expense using more of a cash flow basis there in the numerator. Now we'll look at these long-term solvency measures using the mini case at the end of the chapter, the financial information for S&S Air. For the total debt ratio, we'll compare debt to assets. Debt consisting both of current liabilities as well as long-term debt. The sum of those would be the total debt, and we'll divide that by total assets to see how much of S&S Air's total assets are financed by the use of debt, both current and long-term liabilities. So when we go to S&S's balance sheet, the total liabilities we've seen before have already been totaled for us, $2,773,050, and the long-term debt is $5,050,000. So the total debt, being the sum of those two, then divided by the total assets of $17,379,480 from the balance sheet, indicates that 45% of S&S's assets have been financed by debt. That's actually a little bit below the industry median. It's a little bit low, not terribly low, meaning that S&S relies upon debt a little less than the typical competitor in its industry as measured by the median of that total debt ratio. So S&S uses a little less debt than its competing firms in its industry. The second long-term solvency measure is times interest earned, which shows us how many times the firm's been able to cover its interest expense through the generation of earnings before interest and taxes, EBIT, also called operating income. If we look at S&S's income statement, then we see EBIT, or earnings before interest and taxes, has already been calculated for us, $3,648,604. The interest expense of $573,200 obviously has been covered several times over. So we take that EBIT and divide it by the interest expense, and we see that S&S has been able to cover its interest expense by generating operating income 6.37 times over. So its interest expense is covered 6.37 times over by the use or generation of operating income. The industry median actually is higher than that, a little over 8 times. So even though S&S has a little less debt than the typical firm in the industry, it's covering its interest expense only about 6 1/3 times, and the industry is covering its interest about 8 times over. So it's a little bit low on its times interest earned, even though it is a little bit low in the use of debt in the first place. The third long-term solvency measure is the cash coverage ratio that looks at covering interest expense actually through the generation of cash. So it takes that EBIT, or operating income, and adds back that non-cash deduction for depreciation expense to see how interest expense was covered on a cash basis. So take the same EBIT we used before and add the $1,640,200 of depreciation expense that we see on S&S's income statement, and we'll see their cash coverage ratio was 9.23 times. 9.23 times they covered their interest expense through the generation of cash as measured by EBIT plus that non-cash depreciation expense deduction. The industry median was 8.43 times, so their average is actually a little bit better than average to good, I'll say, in covering their interest expense on a cash basis. So perhaps they had a lot of depreciation expense compared to their peers, and that caused their times interest earned to be low because the depreciation knocked the EBIT down. When we add that back, they actually looked quite good. So perhaps they had a lot of non-cash depreciation that adversely affected this times interest earned, and since it was added back, it didn't have an effect on the cash coverage ratio. So it's that type of analysis that we have to try to look more deeply sometimes to get a better understanding of why one ratio could indicate not very good coverage of interest, for example, and another ratio trying to measure the same thing actually indicates a fairly good thing for the same firm at the same time. The third category are called asset management, or typically turnover ratios. Here we're looking at the firm's ability to convert its accounts receivable, which are this credit we've extended to our customers. They have our cash in their hands. We've sold to them on credit, so they haven't paid us yet. Or our inventory stockpile, so converting either receivables or inventory into cash on a timely basis. Ratios used to see if the firm is able to do that, there are several of these, and some of them are just inversely related to one another. So we're trying to see how well the firm is converting receivables and inventory into cash. The first one is total asset turnover, which is sales divided by total assets. We employ assets to help us generate sales. Everything else equal, I would like total asset turnover to be higher rather than lower, because I tend to want more sales. Or if I could generate the same sales on a smaller investment in total assets, I could liquidate the excess assets and put them into something more productive. So there's two ways to boost total asset turnover. Inventory turnover is cost of goods sold divided by inventory. Now, when we talk about turning our assets over, we're using sales in the numerator. When we talk about turning our inventory over, we use cost of goods sold. That's because inventory is measured on a cost basis. When we purchase inventory, it goes into the inventory stockpile at the amount we paid for the inventory. When it comes out of the inventory stockpile because we've sold it, then that would flow through the income statement as cost of goods sold. So inventory is measured at cost Cost of goods sold is measured at our original cost when it is sold and comes out of the inventory. Days sales in inventory is one of these ratios that is inversely related to another. We're trying to determine here how long it would take to sell out our inventory, or how many days worth of sales we are holding in our inventory stockpile. If we see that if we stop purchasing any inventory and it would take us 6 months to liquidate the inventory we have, so we have 180 days of our sales in our inventory, that would tell us something very different than if we only had about 30 days worth of our sales in inventory. In one case, 180 days, we have a whole lot of inventory compared to our sales, and 30 days worth would be typically not very much inventory compared to our sales. In this case, we take 365 days in a year and divide that by how many times our inventory turns over within a year's time. So we know inventory turnover is calculated cost of goods sold over inventory. For example, if you're turning your inventory over every 30 days, then you would have about, when you take the 365 days and you're turning your inventory over every 30 days, you would have about 12 days of your sales in inventory. Days sales in inventory is one of those ratios that is inversely related to another ratio. In this case, inventory turnover, which is cost of goods sold divided by inventory, is inversely related to days sales in inventory. In other words, the more times you turn over your inventory during a given year, probably the fewer days worth of your sales you actually have in your inventory. To calculate days sales in inventory, we take the 365 days in 1 year and divide by our inventory turnover, which is the cost of goods sold divided by inventory. For example, if you turn your inventory over a dozen times during a year, that's approximately once per month. If you turn the inventory over 12 times during the year, that means your average inventory item is purchased into your inventory stockpile and sold, and then repurchased and resold, and you go through that purchase sales cycle 12 times. You turn your inventory over 12 times during a year. You would have about 30 days worth of your sales in inventory. Take the 365 days in a year, divide by an inventory turnover of 12 times per year, and the days sales in inventory would be about 30 days. If you turn the inventory over 12 times, you would turn the inventory over about every 30 days. You would have about 30 days worth of sales in your inventory. Accounts receivable turnover is sales divided by accounts receivable, and then the days sales in receivable, how many days worth of your sales are in your customer's hands instead of being in your bank account, would be just like the days sales in inventory. Take 365 days and divide by that accounts receivable turnover. So if you turn your receivables over, say 4 times during the year, you would divide 365 by 4, and that would mean about every 91 days you are turning those receivables. You have about 91 days worth of your sales tied up in your customer's hands, not in your hands. Days sales in receivable is more commonly known as the average collection period. How long does it take you on average to collect what you sell to your customers on credit? So think about it. Days sales in receivables is how many of your days worth of sales are in your accounts receivable balance instead of being in your checking account, and that tells you how long your customers are taking to pay you on average. Turnover is how often something is sold during the year. So if you notice, a turnover ratio tends to have sales in the numerator or something closely related to sales like cost of goods sold. So those turnover ratios tell you how many times you sell something. It's the sales for the year divided by the thing you're measuring the turnover of in the denominator. Looking at S&S's information, from its balance sheet and its income statement, we can calculate these asset management ratios. Our first asset management or turnover ratio is total asset turnover, sales divided by total assets. It shows you how many dollars in sales are generated from each dollar that's been invested in total assets. So for S&S, they've invested a little over $17 million in total assets and produced over $36.5 million in sales. So each dollar of total assets is generating $2.11 of sales. The industry median is only about 85 cents in sales per dollar invested in total assets, or the sales are only 85% as large as the total assets invested. That indicates S&S Air is doing an excellent job of putting the total assets to use to generate sales dollars, well over 2 times the industry median, which is excellent. S&S is doing a good job employing its assets to produce sales dollars. Again, the sales came off the income statement, total assets came off the balance sheet. Total assets have been totaled on the left-hand side of the $17,379,480 on the balance sheet. The second asset management or turnover ratio is accounts receivable turnover. It takes sales and divides by the accounts receivable balance. We've already used the sales number there. We use the same number again. We now divide that by the accounts receivable balance of $637,560 that came off of S&S's balance sheet, accounts receivable balance. Now remember, that's the accounts receivable only as of this particular balance sheet date in 2012. We don't know which part of the year that is. We only have one accounts receivable number to work with. So when we take the sales and divide by accounts receivable, we see that each dollar invested in accounts receivable, which comes from extending our customers' credit, each dollar tied up in accounts receivable actually produced $57 in sales. The industry median was a little below 10. So S&S is doing an excellent job of, even though it is investing $637,000 in accounts receivable, that investment is generating a lot of sales dollars, much better so than the industry median would indicate. Days sales in receivables, or the average collection period, is calculated by taking the 365 days in a year and dividing by how many times the accounts receivable turned over during a year. So if your accounts receivable sale was made on credit and it's collected and that process is repeated 57 times during the year, then over the course of a 365-day year, that cycle of selling on credit and collecting has occurred 57 times, then that on average occurs about every 6.36 days. So they make a sale on credit and collect it about every 6.36 days. The industry median is a little over 37 days. Take 365 and divide by the industry's accounts receivable turnover. S&S is collecting its credit sales in about 1/6 the time as the industry median. So S&S is doing an excellent job collecting its sales that it makes on credit. Cost of goods sold, we already indicated that would come from the income statement. The inventory balance will come from S&S's balance sheet. $933,400 is the inventory balance. The inventory turnover is cost of goods sold divided by inventory. We see that that's 28.57. So the firm's cost of goods sold, which is items coming into inventory and then being sold out of inventory, is 28 times as large as the inventory balance it had on the balance sheet date in 2012. So that indicates that the average inventory item moved over 28 times into the inventory account and then was sold out. So the average inventory item moved into or through the inventory account a little over 28 times. So they were selling the average inventory item about 28 times during the year. Of course, that's not a physical count of inventory. That's using the dollars of cost of goods sold and inventory. hopefully that indicates the actual physical flow of goods was moving into, through, and out of the inventory account a little over 28 times per year, and it's only about 6 times for the industry median. So S&S is moving the average inventory item over 4 times as frequently as the industry median, which is excellent inventory turnover. The days sales in inventory is very similar to the days sales in receivables. Take the number of days in a year and divide by that inventory turnover amount. If the average item turns over, goes into the inventory account and is sold out a little over 28 times during the year, then in 365-day year, something happens a little over 28 times during that year. It's happening about 12.78 days that the inventory item turns over or moves into and out of the inventory account. We calculate the inventory, days sales in inventory for the median firm by taking the inventory turnover for the industry, dividing 365-day year by that 6.15, and we see that the median for the industry showed the average inventory item staying in the inventory about 59 days, and S&S had the average item in inventory a little less than 13 days. So obviously, if they have a really good inventory turnover, okay, S&S had a really good inventory turnover compared to the industry. It was very high turnover. Then the number of days the average inventory item is in inventory would be very low, which it is. So these are all good signs about S&S Air. They're turning over their assets frequently. They're turning over their receivables frequently, so they don't have the receivables very many days. They're turning over their inventory frequently, so they don't have their inventory items very many days. These are all very good signs for S&S Air.